Good morning from London. I'm Anna Edwards alongside Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. Donald Trump raises steel and aluminium tariffs to 50% in a bid to boost local manufacturing, but raising tariff concerns. The UK is exempt from the higher rates. US job openings pick up, boosting stocks, but a lack of rate clarity means traders are increasingly betting on a wider range of Fed outcomes. Plus, the Dutch Prime Minister hands in his resignation, setting the stage for a snap election after far-right leader Geert Wilders pulls out of the ruling coalition.
A very good morning, Anna. Checking in on these markets, and the optimism around that better-than-expected US JOLTS data is offsetting the negativity around that OECD growth downgrade. It was better than the street's view anyway, and it's powering stocks in the Asia session, powering European futures. Wall Street's already had time to digest it, so futures just flat there. But traders continuing to price in 2 Fed cuts this year, so the dollar recovering somewhat from its lows. Euro dollar, therefore, on the back foot. We're at a 113 handle as we head towards the cash session here in Europe, and the countdown to the opening trade starts right now.
Welcome to the programme, everybody. This is the opening trade. It is Wednesday, the 4th of June. We have a host of data points and events still to come this week. Non-farm payrolls looms large on Friday. Before that, we get an ECB rate decision. We've got the German Chancellor over in the White House. All of these could be hugely newsworthy events, Lizzy. So that's the week ahead, if you like. But in the moment, we need to focus on the fact that, well, markets are not really going anywhere right now. We might see a bounce at the start of trade today, but US futures pretty flat. What's the latest news flow? Well, one of the elements there is trade, of course. 50% aluminium and steel tariffs now implemented by the United States. 25% was not enough, it seems, according to President Trump. He's citing national security and defence reasons. The UK gets an exemption, at least staying at 25% for now. So a lot of conversation about where this goes. And meanwhile, companies are working out how to manage all of this. Remy, Cointreau withdrawing their guidance, citing tariff concerns.
Yeah, as we discussed yesterday, taco, Trump always chickens out, all well and good if you're in financial markets, but not so if you're a business and you need to think about how it affects you going ahead. So we're seeing that from Remy Cointreau. You mentioned the UK exemption from these steel and aluminium tariffs, perhaps vindicating Keir Starmer, the UK Prime Minister, going early when it came to the UK-US trade pact and actually managing to get this carve-out where we were kind of wondering whether he would, because, of course, the President is so tied up with the court ruling, but alas not, and good news for the UK. So the rest of the world, though, facing these tariffs as of 5:01 a.m. London time. And then, of course, the uncertainty continuing around China and the EU and their two relations with the US. So the back and forth continuing, but still no Trump-Xi call, although the US seeming quite optimistic that one is on the cards.
Right, yes, and this is crucially something the market is looking for. We had a conversation yesterday with somebody with Trump first-term experience who was telling us that, when these two people get on the phone and talk to each other, real progress can be made, but we don't have any confirmation of if that is going to take place. In the meantime, you nodded to this a moment ago, we've got the Remy news, we've got Remy trying to deal with the trade tariffs that are in place, we've got aviation trying to deal with all of the back and forth on tariffs as well. And here we see an interesting report by our colleagues at Bloomberg. China is considering ordering hundreds of Airbus jets in a major deal. And once again, this ties into our top agenda item this morning, to tariffs, because, of course, the tensions between the United States and China perhaps made a deal around Boeing planes a little bit less likely.
Yeah, and this just shows the coziness between China and the EU, perhaps, as the US and China are coming to blows, it seems, again, over many, many things, not least the Chinese student visas, but also the lack of exports of critical minerals from China to the US, which is ruffling Washington's feathers. But look, all of that tariff uncertainty continuing, but what really seems to be driving sentiment today in the market is the US economic data. And we've been waiting for the cracks to show in the hard data to stop this US equity rebound. But it's not come from the JOLTS data. Better than expected yesterday.
Absolutely, better than expected. So that provided a bit of a boost for US stocks during the session, and there could be more of that to come for European markets this morning. But looking at US futures, they're pretty flat, aren't they? As if we're not sure what's the catalyst after this. But for the moment, the Fed's view around jobs stays in place. The jobs market looks pretty resilient. At least that's the top line of those JOLTS numbers. Bloomberg Economics, though, does have some words of caution. If you're looking beneath the hood, they're saying, OK, so you've got higher job openings, but there was weak weakness in certain areas of the market where you would expect to see pullback if the economy was slowing. So, for example, hospitality and leisure and travel and the like. They also saw an uptick in layoffs, and the number of quits came down as it became more difficult perhaps to move to another job.
And as you say, the top line is that the labour market is resilient for now, but it's not just economists who are questioning it, it's also the market. So if you see that resilience vindicating the Fed and its hold rate steady position, actually if you look at the options market, many taking out bets, taking out protection on a whole host of possible outcomes. Yes, the market's currently pricing 2 Fed cuts for the rest of the year, but many seeing no cuts at all, some seeing half-point cuts in 2025. So anything could happen.
Yeah, absolutely. And that anything could happen trades is exactly what we're seeing being priced in by those who are hedging their exposure around interest rates. So really interesting to watch how that develops, and a story that we referenced in our headlines. Now, so we're not seeing much movement in US futures. Where we have also not seen much movement is in Dutch bonds, and that's on the back of the news out of the Netherlands. We covered the run-up to this yesterday during the programme, didn't we, when we heard from Geert Wilders that he was pulling out his Freedom Party from the ruling coalition. But now we've heard from the Dutch Prime Minister, and he's resigned. So Dick Schoof has now resigned. He's going to become the caretaker leader of the Netherlands. Snap elections being called. And interesting that we saw no movement in Dutch bonds, because a couple of voices in our reporting this morning saying, well, look, you've got a caretaker government, they're just not going to do very much, and as a result, the market not too nervous about more taxing and spending.
Yeah, the AEX taking a little bit of a knock, but recovering yesterday. So again, the market reaction pretty limited to this yesterday. I had an interesting conversation with Ros Matheson, our EMEA News Director, yesterday, talking about the balance of power in Europe and whether, Geert Wilders is showing that the right wing is stronger.
Yeah.
We've already seen the win for the nationalist candidate in the Polish presidential election.
Yeah.
But she made the point, by their very nature, nationalists don't stand together. So actually, perhaps across Europe, it's not a stronger force.
Right, yes. What does a lot more rule by nationalists mean for the coherence of the EU is a really interesting question, isn't it? And it is, once again, migration that has brought down another Dutch government. Mark Rutte, of course, paid the price, now he of NATO, and we'll get to that later on this month. But, of course, migration then continues to be a hot political topic around Europe. Let us tell you what is coming up on today's show. Jane Foley, Rabobank FX strategy head. Great voice to have with us. A lot of questions about how weak the dollar can get. How strong can the euro get? We approach an ECB rate decision tomorrow, of course. And Julius Baer, portfolio manager, will be with us as well. So we'll get thoughts there at the open of the European markets. Lars Christian Bacher will be with us as well. Morrow Batteries CEO. And if you haven't heard of this business, then this is part of the European ramp-up in production of batteries. Europe trying to become more self-sufficient on battery technology, not destined for EVs perhaps, but for a whole host of commercial applications, Lizzy.
So some fascinating conversations to come up on the programme. We've got plenty in the day as well. Let's set you up for that. We've got later on today the US Trade Representative Jameson Greer meeting the EU Trade Commissioner Maroš Šefčovič at the OECD meeting in Paris as we inch, of course, towards that July 9th tariff deadline. Then at 12 p.m. London time, we have the US mortgage applications data. 1:30 p.m. London time, the Fed's Raphael Bostic and Cook at the Fed Listens event. 2:45 p.m. Bank of Canada rate decision, and then 3 p.m. London time, the US ISM services data ahead of the all-important non-farm payrolls report tomorrow. Friday, I should say. I'm losing my track in the middle of the week.
Absolutely. Here is what else we're watching for this morning. Let's get up to date on some of the other news on the Bloomberg terminal. South Korea's new president has pledged to revive economic momentum following 6 months of political chaos spurred by his predecessor's martial law declaration.
민생 회복과 경제 살리기부터 시작하겠습니다.
I will begin with restoring people's livelihoods and reviving the economy. With the mindset of fighting against a decisive battle against the recession, I will form an emergency economic response task force. With government funding acting as a catalyst, we will restore the virtuous cycle of the economy.
South Korean stocks jumped after Lee Jae-Myung took the stage at his inauguration ceremony. Lee won 49% of the vote, comfortably beating his opponent from the People Power Party. Volkswagen is planning to reduce its German workforce by about 20,000 employees through voluntary departures. Europe's largest car maker is restructuring in response to rising costs, weaker European demand and increased competition from Chinese car makers. In December, the company struck a deal with unions to slash production and reduce headcount by 35,000 by the end of the decade. And Germany's new government is reportedly planning a €46 billion corporate tax break package to stimulate its economy. According to the Financial Times, the finance minister will outline the measures at a cabinet meeting later today. The initiative is in addition to a massive debt-funded public spending plan to modernise Germany's armed forces and infrastructure. Thought worth including the report around Germany as we look ahead to what will happen later on then on the German front. But because there's so much German news flow this week, we have Friedrich Merz, the German Chancellor, heading to Washington, heading to the White House, Lizzy. What on earth can he expect? We understand from our reporting that he has been canvassing all kinds of views around Europe around how to handle this. On the one hand, you might think they get on well. They have golf in common, they have business in common, and there are areas of agreement, like Europe needs to spend more on defence. Germany is definitely doing that. But on the other hand, cars, trade, all of that could get quite difficult.
Well, of course, the relations weren't so warm with Olaf Scholz, his predecessor, who had backed Biden and Harris in the presidential race. But then I wonder whether Trump is going to be so pleased about the corporation tax cuts that you were just talking about. Surely that's exactly what the revenge tax, Section 899, is supposed to get back at. And it was interesting yesterday that Ludovic Subran of Allianz had said that could knock the dollar 5% as the overall big, beautiful bill. So something to talk to Jane Foley about later in the programme.
Yeah, absolutely. That's Section 899 of the big, beautiful bill. What does that do to the desirability or otherwise of US assets? Certainly something we'll keep returning to, a big theme for investors.
Well, speaking of investors, the world's largest forum on private capital is underway in Berlin, and our very own Kriti Gupta, in case you were wondering where she is at the event with a strong lineup of interviews from the sector. So, Kriti, tell us more.
Well, Lizzy, Anna, the place to be in Europe right now is right here in Berlin at SuperReturn, because we're talking about these major themes that we've been discussing on the show for months now. The idea of volatility coming out of the United States and what the European reaction function is to that, but also how attractive that makes Europe in the broader scheme of things. On top of that, talking about things like delays in the capital markets. 2025 was the year of the deal flow, the year of the IPOs. That was what it was touted just 1 year ago right here in Berlin. Does that continue given all the volatility? And in the face of that pause in the equity markets, is this the moment for private credit? Those are the conversations that are being had here, because there's so much enthusiasm for private markets, but we are having the same issue here that you see in every other asset class, which is how to navigate that. In a few minutes, we're going to be talking to an exclusive interview with Jim Zelter, the president of Apollo, one of the largest private players in the world, an AUM of something like $785 billion, on track for $1 trillion by 2026. How is he deploying that capital? What deals are interesting to him? And where does Europe fall into that playbook? We're going to dive into all of that in just a few minutes. Stick with us. This is Bloomberg.
Welcome back to the opening trade. European equity market futures pointing a little bit higher this morning. We've had at the margin perhaps some disappointing news, also some potential orders news from the aviation sector. So maybe all that adds up to neutral for European stocks and our expectations ahead. But perhaps we need to catch up with the US session of yesterday. US futures, though, are pretty flat. So not a clear sense of the next catalyst. Will we find one in Berlin? Leaders of private capital are gathering at SuperReturn Berlin, the industry's biggest forum. We just heard from Kriti, who is on the ground at the event and joins us now. Kriti.
Anna, Lizzy, this is the place to be in Europe today, because this is a conversation where perhaps we get some answers on where that European exceptionalism trade goes, the legs it has, and how the Americans are perhaps thinking about it. I've got the perfect guest to have that conversation. Jim Zelter, the president of Apollo, joins me here for an exclusive interview right here in Berlin, overseeing about $785 billion AUM. That's for Apollo as a whole. Jim, a pleasure to have you. I think you'd agree that this is the place to be in Europe today.
I've been to Berlin many times, but my first time at SuperReturn, and it's wonderful to be here. And it is ironic how the breadth of players here at SuperReturn used to be really a private equity conference, and now it really is a conference of all players in the credit markets, in the capital markets, and in the equity markets. So thank you.
Of course, we're thrilled to hear what you have to say. Now, this is fascinating as well, because we talk about this from an asset class perspective. We'll get to that in a moment. Let's talk about the overarching trade. We're based in London. You're based in the U.S. as well. We're talking a lot about whether or not this kind of exit, perhaps, or at least this moment that Europe has had in the sun, actually lasts? Give us the bull case for Europe here.
Well, we've been in Europe for 20, 25 years. We probably have 100 billion of our 800 billion here in Europe today. And whether it's a pull domestically or a push from the current administration, there's certainly a revitalized enthusiasm about investing in Europe. I had a dinner last night with 20 financial players, and the amount of U.S. investors that are looking to invest in Europe is very real and palpable. You know, for us, with our financing toolbox, and our high-grade capital solutions, in reality, most of our transactions over the last 2 years have been in Europe. Intel in Ireland, Vonovia here in Germany, Air France. So, you know, we've seen it for the last few years where on the global stage, the leaders, the national leaders in industry and energy transition, in utilities and manufacturing, they want to be competitive globally, and they're looking for more tools to be able to play in a bigger game.
How much of that, though, is a structural bull case for Europe as opposed to a reaction function to perhaps the volatility emanating out of the United States?
We don't spend as much time thinking about whether it's a pull or a push. On the ground, when we see activity from national champions in industry, and we see it with industrial players, and we see it with financial players, and we see it with government entities, certainly in Germany, you're seeing it right now with this current administration, a real pull. But we see palpable signs, lots of green shoots of great enthusiasm. And certainly there's a variety of things you'd like to change, but for our perspective right now, it's a wonderful place to do business.
How much of that, though, gets a stamp of approval or a little bit of backing because of the fiscal spend from governments? I mean, it feels like Germany's bull case has been a big piece of that, but is it just Germany that's kind of holding Europe afloat at the moment?
Well, I think in Germany it's very easy. This is a 4 trillion economy. Their goal is to get to be a 6 trillion economy over the next 10 to 12 years. We're prepared to put in over 100 billion of capital from our financing tools. And I really say that in terms of capital, mostly investment-grade financing and a variety of other financing tools. But Germany, because of the size and scale and their prominence in the European marketplace, they are a leader. But we're seeing enthusiasm happening right now in the Nordics. We're seeing enthusiasm happening in France to a certain degree, obviously different industries. But it's a palpable change that we want to be part of. And I think that for our perspective, we are a large player here, but in the world of private capital and the private credit, it's an opportunity that we see as one of the brighter ones around the globe right now.
You mentioned private credit. You took me right there. There's a lot of concern in this market right now that because of the optimism in private markets generally, but also the financing and the deals that are coming from the credit space specifically, that maybe it's gone a little bit too far. You've heard warnings echoed from some of the giants of finance. Walk us through what a red flag might look like in that space.
Well, we've been fortunate. We've not had a real recession in the U.S. for several years, a very long period of time. I will point out that, you know, a place like Australia really hasn't had a recession since the early 90s. But certainly there's been a tremendous growth of a variety of credit markets, whether it's investment grade, high yield, direct lending. And I think we have to differentiate between a credit cycle and industries where there may be an overabundance or an overenthusiasm. So certainly what's going on right now with in DC with reimbursement, the whole area of healthcare and medical reimbursement, you want to make sure that you are not overly concentrated to any one player or any one provider. In the enterprise software business, a lot of concern about technology change and technology innovation in light of AI. And certainly also you want to make sure you don't have a concentrated business. So those are really red flags that would be the case in any credit cycle. But certainly as we are a bit long in the tooth in the cycle, you have to be more focused on it at this point in time.
You mentioned the risk out of Washington, D.C. specifically. Connect the dots for us in terms of those deficit concerns out of D.C. to the private credit space. How quickly do you see an effect?
Well, you know, right now, while the tariffs and Liberation Day got a lot of the headlines, the market forces, the so-called bond vigilantes, have woken up those to the concern about the growing deficit in the United States. So in the marketplace right now, with a little bit slower growth and some concern, a lot of hand-wringing, the deficit issue has taken the main stage versus the impact of the tariffs. Now, this administration, we can't get too comfortable. There can be a headline in the next few minutes that change that. But right now, the big focus is on rates, and the deficit, obviously, as the current administration is focusing on their big, beautiful bill.
When it comes to kind of the folks you're speaking to here in Berlin or around the world, how does that sentiment you just laid out affect perhaps the nervousness in terms of credit lending, but also kind of in the equity space as well? Are you seeing some of that nervousness rise to the top?
Well, I think we've been very clear about the role that we play as a broad-based capital provider, and I think that when you see the macro headlines right now, your calibration of risk on levered equity needs to be a bit higher. But at the same token, you have real rates, 4% plus on nominal rates in the U.S. right now. And for our perspective, as a credit lender, you're getting paid for the first time in the last 15 years. So it's a wonderful time to be a player in credit. But at the same time, I do think there's appropriate caution with buying equity at the bottom of a levered capital structure.
So in the public markets, there's a conversation here about holding onto cash, holding onto capital, being on the front end of the curve to kind of have that liquidity. Private markets offer the opposite. It's fairly illiquid. It's not as easily tradable. It's a more long duration asset with the deficit concerns. A lot of folks are pulling out of that. Are you telling me that that's not bubbling to the surface?
Well, I think, again, private credit is a much broader ocean of opportunities where a lot of the issues you mentioned, they're really focused on the non-investment grade side, which is a $1.5 trillion marketplace of direct lending. The larger opportunity, when we're more focused as a firm, and 3/4 of our assets are on the investment grade side. So a different setup with regard to the underlying credit metrics, mostly investment grade, mostly top of the capital structure. And with rates are where they are right now, again, people don't typically buy spreads, but they buy yields, and yields are quite strong right now. So appropriate commentary and concern about the non-investment grade marketplace, and certainly a lot of concern about levered capital structures, subordinated paper, PIK payments and things of that nature, which we've avoided. We're clearly leaning massively into the investment grade side of the world of private capital. And I would say also in the past, a lot of the issues you brought up, in the past, historically, private has been risky and illiquid, and public has been safe and liquid. We would really challenge that convention, and we're seeing it more and more on these investment grade opportunities that we've been a leader and owner of.
We're starting to really see that sea change in terms of the allocation, of course, how people are viewing that as well. Jim, pleasure to have you. Thank you so much for joining me here in Berlin. Anna, Lizzy, this is the conversation that Jim is talking about in terms of how the private markets are digesting some of that tariff risk, the liberation risk, the deficit risk over in the States as well, and how that actually helps bolster the bull case for Europe that may already be in the works for a while here.
Bloomberg's Credit Gupta in Berlin at SuperReturn. We thank you, and we'll come back to Chrissy later in the programme. Jim flagged there that the headlines could break at any moment, and indeed they have. Donald Trump waking up on Truth Social as that conversation is happening, Anna.
Yeah, absolutely. I like President Xi of China, he says, always have and always will, but he is, all caps, very tough and extremely hard to make a deal with. I don't know about a deal. He's trying to get a phone call at the moment. They want to have a conversation, don't they? A lot to talk about with Jane Foley on FX markets. Where does the dollar go amidst all of this? We'll be back. This is Bloomberg. Welcome back. This is the opening trade, Wednesday, the 4th of June. This is the picture for European futures. We're pricing in a little bit of upside, perhaps, for the start of the trading day. Not much in London, but elsewhere, perhaps a little more. We've had mixed corporate news flow so far this morning, such as it is. The handover from the United States, a positive one, looking to build on some of that momentum of yesterday. But US futures are flat to negative right now. Lizzy, bond markets. We talked earlier about how there wasn't much reaction to some of the political news flow in Europe yesterday. Things pretty flat this morning as well.
Well, yeah, you mentioned the US JOLTS data yesterday. Markets continuing to price in 2 Fed cuts off the back of that. But there's a whole host of other options being thought about as well. And Bloomberg's Valerie Teitel is with us to set them out. Val.
Lizzy, you set me up there perfectly. Yes, we had that good economic data yesterday, but really the front-end pricing on the amount of Fed cuts this year has really barely budged in the last few weeks, really stabilizing around 2 cuts out to 2025. But there are some very interesting things going on in the options market. We're seeing a very huge dispersion of hedges being placed. Some traders betting for no cuts at all in 2025, other ones positioning for a series of 50 basis point cuts. And I think that really just goes to show that there is an expectation out there that once the Fed is done waiting and seeing, once they get that clarity on the U.S. economy, there could be a big shift in communication from the Federal Reserve, either in a hawkish or dovish direction. We currently don't know. We're still waiting for more hard data to really parse together how the U.S. economy has been holding up amid this tariff uncertainty. We do get more hard data later in the week, Thursday initial jobless claims, and then the big one Friday, non-farm payrolls. With that JOLTS data yesterday, maybe we start to build this narrative of U.S. economic resilience. And the one question on my mind is, off the back of that, do we see the dollar strengthen? It's hovering around year-to-date lows. It's fallen some 9% from all-time or from highs at the beginning of the year. If we do see this dollar strengthen off the back of economic resilience, my mind also goes to what's been going on in EMFX. It has basically hugely benefited from the weaker dollar this year. I've got a chart behind me of this is an index of 8 EMFX trades. It's a carry trade, so it's those who are selling the dollar and using that to fund higher yielding currencies. It's performed really well so far this year at a 7-year high for this index. But the question again on my mind is it further maybe assumptions that the U.S. economy is resilient? Does that really change the narrative for the dollar going forward?
Valerie, thank you very much. Valerie Teitel setting up our next conversation very nicely. She's going to join us around the desk for it, in fact. Jane Foley, head of FX strategy at Rabobank, with us this morning to talk about all things FX. Jane, nice to have you with us this morning. So let's start where Valerie kind of left the conversation there, around what is driving the dollar and whether data can really cut through, because we saw JOLTS yesterday, waiting for non-farm payrolls. In other periods in history, we might have thought this was in the driving seat for FX, but it seems that something else has been driving the dollar of late.
Well, to be honest, the currencies that have gained, I mean, a lot of those EM currencies, particularly in the Asian region, they're creditor countries. They're countries where there is an excess of savers, where there are big current account surpluses, where saving rates are high. And what we've seen, of course, in recent years is a lot of that savings, and this still goes, for Germany as well, for Japan. Over the last few years, a lot of that, of course, is piled into US assets, and now what we're seeing is a reversal back home into these current account surplus countries. So the question is, how long are people going to sit there? How long are they going to say, well, you know what, maybe we need to go back into the US? And that, of course, depends on this hard data that we're waiting for. And right now, we might see some better data. Say, for instance, we get some better data for payrolls. Maybe we get a little bit of news on the trade front. And some participants will think, yeah, you know what, maybe I should go back into the dollar. But I do think it's going to be very difficult for a dollar rally to really get legs until we get some real confidence that the outlook for the US economy has improved.
OK, so we're talking here about whether the cyclical can cut through against the structural. And it's been the structural and concerns about what our guest yesterday from Allianz called capital controls in the United States, or the possibility of them. We were talking about Section 899 of the Big Beautiful Bill. Ludovic Subran at Allianz telling us that could mean, if it passes, a 5% drop in the dollar. So does that cyclical conversation around the US economy, does that stand a chance of cutting through against such big structural headwinds?
Well, in a way, right now, I think the answer is probably not. Something would have to change. And I think maybe if you're a speculator, if you're a short-dated investor, then maybe you can see some value. But if you are a big pension fund willing to or looking to take really long-term structural moves, then you're going to be very, very cautious. And that there lies the conversation. And does that mean that there is going to be more gains in some of these creditor countries? And that would include the euro and the yen, as well as some of the smaller Asian countries. Or are we at the limit now? And we just don't know until we get more clarity from that hard data. I mean, another thing that I would point out, and to Valerie's point about the resilience, or the question over the resilience of the US economy, we've been here before. Go back a couple of years in the post-pandemic period, and everyone was saying, confidence numbers are bad, we're going to have recession in the US. We never got that recession because the hard data never turned down, never indicated that we had that recession. So, the market was wrong. And I think that is probably also in the minds of many investors thinking, is the confidence data overdone? Is the US resilience going to come back again? So, there are lots of different moving parts clearly in this argument.
You mentioned the euro, Jane, and I've got the ECB on my mind. Frankfurt tomorrow. Christine Lagarde, of course, using this weakness of the dollar as an opportunity to tout the euro. How realistic is that? Is it like the Eurozone debt crisis is far enough in the rear view that we can realistically see it or start talking about it as a reserve currency?
The euro has around about 20% of reserves. But what Lagarde didn't point last week when she was making that speech was that that hasn't changed, because de-dollarization has been a theme really for at least 20 years, as I said, to the beginning of the century. And what we've seen in that period was the amount of dollars in reserves going down and the amount of renminbi taking up about a quarter or about a third of that slack. And then maybe because there's more active management within central banks, think of those big funds, say in Norway, for instance, more active management. They've been buying a little bit more Aussie, a little bit more Canada over, the last 25 years. But they haven't been buying any more euro. They haven't been buying any more yen. They haven't been buying any more sterling. And that perhaps is surprising. Now, it is an opportunity for the euro. It certainly is. And in a way, the solution is both very simple, but both very and very complex at the same time. Because if Germany, for instance, if Europe can get its act together, if consumption can really rise in the region, well, there will be an answer. The euro's strength, if you like, will rise. But trying to overcome the structural issues in the eurozone that we've had for so long, all the different factions within it, the lack of union, the factors that created that debt crisis. Back in the 90s, so many economists were saying, is EMU actually a workable thing when you don't have fiscal union?
But not to make it personal, right? But isn't it in Lagarde's favour that Trump is threatening Powell's job? If you have Powell replaced, how much does that change the case, the positive case for the euro?
Well, it certainly will. And I suppose academics would say, some of the legislation with respect to education and financing universities in the US, that is all perhaps going towards Europe's favour too, because just as Europe, years ago should have got its act together with respect to defence, so it should with respect to tech as well. So it needs a tech startup, it needs the brains, it needs the innovation. And so all of these policies could go in the euro's favour. And it really could. It does have an opportunity. It really could become more of a reserve currency. But there are so many ifs and buts and structural issues to overcome as well.
Jane, when you were talking about the dollar previously, you mentioned that it feels very much like the post-pandemic period where we were just waiting for the hard data to match the soft survey data. Given that we could be waiting for months, maybe until the end of the summer, for some clarity on the labor market in the U.S., do you think that maybe the lack of bad news is enough to have the dollar strengthen on the back of that?
If we got a lack of bad news, but then the market will be looking at the budget issues, considering that as bad news, it will be looking at the lack of more progress on trade deals with the deadlines approaching as bad news. So in a way, the absence of news, perhaps it may not be enough, because the absence of news in this front is bad news, because we need progress on the trade front. And, we need a little bit more reassurance, I think, on the US fiscal front at this point as well.
Yeah, I know we have the ECB tomorrow, but we also have this overhanging trade discussions going on between the US administration and the EU with this threat of 50% tariffs to come in at the beginning of July. Do you think that's something that the euro is pricing in at the moment? I know it's hard for the euro, hard for FX, frankly, to price in that kind of risk.
Possibly not, because I think what we have had in the euro this year is before, the April the 2nd Rose Garden address, before that, we had a lot of optimism with respect to the euro because of Germany's debt break. So many people saying, well, that's the game changer. That's when the euro's rally really started. So we've had a lot of good news with respect to the euro priced in. And I think if we get this realisation that, the trade issues with the US are potentially worse than the market's pricing in. If the market begins to really take on board, well, actually, Germany is still going to stagnate in 2025. We're not going to see, growth until 2026. And then we're going to have potential headwinds from growth. There is the possibility that we do get some profit taken in some of those long euro positions. And the other thing is that there's a limit to how many, European defence stocks that investment managers can buy. The depth of the US market is so much bigger that there may become a point when people are sort of forced to look beyond, those sort of knee-jerk positives into the European defence, into European infrastructure maybe, and actually think, you know what, I'm going to have to look back at the US market.
I'm almost amused at the thought, Jane, that tomorrow, whilst the ECB is ongoing, and we're all very much focused on that, we'll also be having to watch the White House and Friedrich Merz a little bit later on in the day in the White House, and FX markets could even move on things that President Trump says to the German Chancellor about the autos industry if we start to price things in there. So that's an interesting dynamic to watch in tomorrow's session. Back to the US, you were talking about fiscal concerns. Elon Musk has been saying that the proposed tax bill more than defeats all of the cost savings that he says he made when he was leading the Doge team. Where do your fiscal concerns lie? Or maybe more importantly, where do you think the market has come down to in terms of fiscal concerns around the United States? Because I've heard so many varied views about where this bill will leave the fiscal picture.
And, the White House is saying that it's going to all pay for itself in economic growth. Doesn't that remind you of Liz Truss and all the warnings that it was going to end in tears for sterling?
Yeah. I mean, the answer is yes, and I think the market's begun to take that on board. I mean, what's quite interesting is the starting point, excuse me, because if you look at the end of last year, we were all up in arms about the French budget. And yet, at the time, the French budget deficit was around about 6% of GDP. The US was 6.4%, and nobody was looking at the US. Because why would we? Because the US, was exceptional. And there are many different ways, I suppose, depending on your starting point, that you could define US exceptionalism. But I think one definition would be the ability, really, of the US to have this massive, great big budget deficit and debt, and no one really to care about it, because it was always going to be funded. And yet this year, things have shifted. So we have seen investors, moving out of US equities, moving out of debt, moving out of the dollar, all at the same time. And that exposes, perhaps, the US fiscal position in a way that we haven't seen for a very long time, perhaps not ever in my memory. And therefore, the US fiscal position suddenly does matter. And to that point, are investors going to be as forgiving as they used to be about the fiscal position? And the clues are probably not. Now, the US is, of course, a debt nation. It has a current account deficit, like the UK. If you have a current account surplus, like Japan, where your domestics can own, if they want, all of that debt, then it affords you some protection. So the Japanese debt market, whilst it's huge, is never going to be quite so vulnerable. But the US is a detonation. It needs international investors. It is therefore potentially more vulnerable. And before, it's not been vulnerable because it's had this exceptional status.
And yet, it's interesting, Val, isn't it, that talking of Japan there and how Japan could sustain this debt on its own if it wanted to, its domestic holders, we saw a reluctance to step in, didn't we, in the Japanese JGB market at the long end, and that rippled on into treasuries, and so there is still some nervousness there.
Yeah, definitely. I mean, it does seem like there is, I know you mentioned at the very beginning, this repatriation of flows back home to Asia, and whether we do see that. I mean, that can be something that can not only change the fiscal picture in the U.S., but really change the picture for some of these Asian nations having to deal with a currency really strengthening and needing to maybe do something about that to help their exports.
Yes. So this is something that they would not have bet upon, and this is something which will affect their outlook for growth, because they would have no one, I suppose, really anticipated that you'd get the strength. For instance, the Taiwan dollar or the Singapore and many others. So this is something which they will be considering. But it is going to be interesting to see to what degree this comes up, if at all, in some of those trade talks.
Yeah, and of course, Governor Oweda yesterday pointing to the growth risks from tariffs. Plenty to join together. Jane Foley doing it for us, Head of FX Strategy at Rabobank, and Bloomberg's Valerie Teitel. Thank you to you both. Well, coming up on the programme, a potential mega deal. China's said to be considering placing an order for hundreds of Airbus aircraft. More on that scoop and today's stocks to watch. That's next. This is Bloomberg.
Welcome back. The time is 7:48 here in London, which means we're 12 minutes away from a European session that looks as if it could start in positive territory. US futures, though, pointing a little bit lower, flat to negative this hour. Just a quick recap of what we've heard from President Trump this morning. Busy on Truth Social at 7:19 UK time, which is rare, but he is. So this is what he's been saying. He's saying that China's Xi is extremely hard to make a deal with. Also saying he likes Xi, but he's very very tough, very difficult to make a deal with, so some flattery coming from the White House, perhaps, to find its intended audience in China. How is this playing into market expectations of a conversation between Xi and Trump, I wonder? Let's talk to Paul Dobson, Bloomberg's executive editor for Asia Markets, who joins us now. Paul, nice to have you with us. No sign that these kind words by President Trump have moved market expectations in terms of US futures. But I suppose this all plays into market excitement about whether we might see a conversation between these two leaders and whether that could deliver for some further risk upside.
Yeah, I think if there were a call that were confirmed, Anna, the market would view that positively, because I don't think that the market is convinced it's going to happen, no matter how much the US side seems to insist that it is likely and that it is coming. And it feels a little bit like, you know, Trump tweeting at this time in the middle of the night, US, expressing his frustration. You know, I'm thinking of Magnus Carlsen there banging the chessboard in almost anger or you know, kind of dissatisfaction with the way that things are going, and trying to get something more out of the Chinese side. So you know, we've heard all through this week commentary from the US side talking about, don't worry, it'll all be all right. Trump and Xi will get together and they'll have this meeting, but China has been completely silent on the matter. Now, you can read something into that both ways, right? Either they're silent because they're just leaving the US hanging, or maybe there's something coming and, you know, they don't want to get ahead of it. So there are reasons to be excited or optimistic, possibly. You know, the market has certainly been trading with a sort of risk-on-ish kind of a bias this week, not perturbed by things. But there are these niggly sort of escalations going on at the same time, the stuff with the students in the US, some restrictions on tech coming back in again, and on the China side as well. You know, they're not moving quickly on the rare earths. Now, we've heard that that might not be deliberate ploy, but, you know, well, you can make of it what you like. But so no definite signs at this moment that there's anybody coming closer together.
So while we wait for the trade certainty, I should say, Paul, we have to look at the US economic data. We had the JOLTS numbers yesterday better than expected. Traders still pricing 2 Fed cuts for the year. But Valerie was just laying out for us the big range of options when it comes to the Fed path ahead. How much could the payrolls report on Friday change the picture?
Yeah, Lizzy. I mean, the jobs data has been a little bit less strong recently, so I think that's why the market was relieved when we got those JOLTS figures. But the Fed speakers, they've all been so explicit, you know. They're happy with the dual mandate and the way it looks at the moment. They're not too worried about the jobs data. They're not too worried about the inflation data. If anything, they're expecting inflation to come down gradually, depending on the tariff policy, of course. And they're telling us, basically, 2 cuts by the end of the year is what they're factoring in as well. So there's no reason for the market to particularly doubt that based on the data that's been incoming so far. I would have to be an extreme reading one way or the other on the jobs data to really disrupt those expectations when the Fed speakers have been so clear.
Yeah. OK, Paul, just briefly, give us the global perspective on South Korean politics. We've seen the results come through there, and that means higher stocks, at least in today's session. More broadly.
Yeah, Anna, what's the Korean for Liz Truss moment? This is the thing I'm worried about. Again, you know, we had a bit of a wobble at the bond auction today. People worried about those spending plans. And that's the same thing that we've been seeing across Japan's markets. It's the same in Australia. You know, people not showing up to buy that debt. So you've got to be very careful at the moment what you're doing in those markets and not disrupt the view.
All right, Paul Dobson, Bloomberg's executive editor for Asia Markets. We thank you. We'll switch from the macro to the micro now. Joe Easton from our equities team is with us for the stocks to watch. Joe.
Morning, Lizzy. So we're watching Airbus today in Paris after news of a big order potentially coming from China. This is a Bloomberg exclusive from the transport team this morning, saying that China could potentially buy around 300 aircraft, maybe even going up as high as 500. So really a massive order covering both wide body, so long haul, also short haul, narrow body jets as well. So really a huge boost if that is confirmed in terms of the reporting on that one. In terms of the stocks, we tend to look at Airbus versus Boeing, of course. We've kind of seen the stocks converging recently, actually. Airbus giving up a little bit of the outperformance, so potentially we might see that actually extend in today's trading. Then we're also watching metals following the news from Trump that they are increasing the tariffs on steel and aluminium as well. Now, we have seen decent gains for the main metal stocks in Europe over the past year or so. ThyssenKrupp It's actually doubled year to date. So keep an eye on that one. Potentially we could see them maybe trimming at some of these. We'll see how the market reacts in terms of the supply dynamics. Will it be positive? Will it be negative for those companies? Also wanted to mention the industrial sector more broadly, because if the metals prices come up, maybe that could be seen as a negative for the sector. We've seen industrials outperforming this year, so potentially that could be at risk a little bit. Then over in the booze sector, we've got Remy Cointreau withdrawing its guidance, saying that due to the lack of macroeconomic visibility and geopolitical uncertainties, conditions required to maintain their medium-term forecast no longer in place. However, this stock is down sharply over the past year, down 45%. So could it kind of be the bottom coming up in that sector? We can also see the other peers, Pernod, Diageo, Campari, all of them down a lot, so maybe a lot of this negativity on volumes and tariffs already priced in. But keep an eye on the drink sector in Europe this morning.
Joe, thank you. Equities reporter Joe Easton. More from Joe in the next part of the programme, of course. And Lizzy, Joe setting us up there for the start of trade. European futures then pointing a little bit higher, but US futures sort of flat right now, really in search of a catalyst.
Holding their breath until that Trump-Xi call, perhaps, but maybe more likely on the cards after the Truth Social post from Trump this morning, all the flattery heading in Beijing's direction.
Yeah, we'll see whether that is something that is important to get an agreed phone call over the line. We don't have that yet. We don't have a date or any comment, really, from the Chinese on the prospect of that just now. We'll be back with the market open. This is Bloomberg. Welcome back to the opening trade. A few minutes to go until we get the start of equity trading here in Europe. It is Wednesday, the middle of the week. This is what the futures picture, or rather the US picture of yesterday, might suggest we are in store for today here in Europe. So here in the white is the European trade, closing at market highs yesterday, or day highs yesterday. And then the US trade, if anything, it lost a little bit of ground, but perhaps not drastically. And a lot of the optimism around the labour market was the key driver in markets, and maybe markets just happy to tread water as we wait for more clues around the resilience of the US labour market. We'll certainly get those on Friday. Also, of course, waiting for more clues around the trade narrative and whether we get any further progress there. Will we see a meeting between Presidents Trump and Xi? Will that actually come to pass? Even a phone call between the two of them, will that come to pass, and can they make progress on that bilateral trade agenda? In the midst of all of that, then, this is the picture we have for the futures. CAC futures are up by 0.3%. And Lizzy, we're focused on Remy, we're focused on Airbus. A number of big heavyweight French stocks could be in the mix, could be on the move as a result of some news flow.
Yeah, so we keep an eye in France on Airbus. China considering ordering hundreds of Airbus jets in a major deal. This is a Bloomberg scoop just breaking this morning. You also mentioned Remy Cointreau, also factoring into the trade story because they've withdrawn their 2029 to 30 guidance because of all of the tariff uncertainty ahead. Joe Easton was telling us, of course, the shares already down 45% so far this year. Will they fall even more off the back of this news? Of course, we also mind the steel makers as President Trump signs that directive doubling steel and aluminium tariffs to 50%. That came in at 5:01 a.m. London time, so we mind the likes of ThyssenKrupp, ArcelorMittal and Salzgitter as well, Anna.
Yeah, absolutely. We had a heads up on that news flow over the weekend, didn't we? And the steel makers, they moved on Monday. Is that all done? Do we have more to price in? Perhaps we do in Wednesday's session. We'll look to that sector to see if we get any movement there. But apart from that, then, our focus goes to the French market for any big moves in Remy Cointreau, in Airbus, as Lizzy, you were just nicely setting up for us. The European markets are open, not doing a huge amount just yet. The FTSE 100 is flat. Stock 600 managing to eke out gains of 0.2%. So, if anything, a slight bias to the upside. And this fits with what Paul Dobson was talking about earlier on. So far this week, it does feel as if these markets have had some kind of bias to the upside, was his view, given the way we traded around the various news impulses that have been hitting this market. But for the moment, then, Lizzy, we are modestly higher across European stocks. So even the FTSE 100 actually up by 0.2%. The futures picture for London was a bit more muted. We have the CAC then up by 0.4%, the DAX up by 0.6%. So in the absence of a huge amount of negative news flow, perhaps we trade higher. Seems to be the momentum behind markets this morning. Lizzy, what do you see beneath the hood?
Well, that's the geographical picture, green across the screen, and it's pretty much the same manner when it comes to the sectors. So you've got 19 out of 20 in positive territory as things stand. Basic resources leading the gains up 0.9%. Energy at the bottom of the basket down 0.2%. And if we just dive into some of those individual names that we were flagging, so Cointreau, as we expected, down 0.4% after it withdrew its guidance on the tariff outlook. Airbus shares up 1.7% on this Bloomberg scoop that China's considering ordering hundreds of Airbus jets in this major deal. And we were looking at the steel makers as well. Look, yes, the doubled steel tariffs have come in at 50% today, signed in by Donald Trump. But actually, the steel makers appear to have already priced that news in, because all of them that I'd flagged are in the green. So ThyssenKrupp, ArcelorMittal and Salzgitter actually up about 1% this morning.
And it's interesting. Basic resources, then, the best performing sector, Lizzy. But yesterday we were talking about that on the back foot as a result of that Chinese data. So it's sort of a day down and a day up for the basic resources sector. So not a huge amount of standout news flow, I suppose, at the corporate level this morning. But we have, of course, got Remy to focus on and Airbus.
Indeed. Well, should we get some analysis of what's really happening in these markets? And Doe, portfolio manager over at Julius Baer, joins us around the desk. Good to have you, Anne. I mean, we've been debating it all morning and all week, really. How much more upside is there for European equities amid all of this uncertainty?
Good morning. Thank you for having me. Look, in terms of the European trade, we are still running an overweight to Europe, albeit we are being a lot more selective. So since February and beginning of last year as well, we've had a thematic in Swiss stocks, and that's our element of sort of protection, defensiveness within the portfolio. On top of that, we have high-quality companies, whether in luxury autos, whether in semiconductors. So we like to hold over the long term. So if we think about the European trade so far, there's no longer that steep discount. You know, the Europ at 15, 16 times. There's no longer that steep discount versus the rest of the world. So I think the easy money has been made. It's time to be a lot more selective at this point.
I mean, your view isn't as simple as sell America, is it? So, you know, when you're looking at the US, what's actually worth buying or holding on to in US assets?
There's still room for US assets that are truly unique. If I take a step back and think about the earnings season that's just been, the Magnificent Seven or the large cap tech in the US is still growing earnings at high 20-30% year on year, whereas the rest of the market is in high single digit, and you're seeing much slower growth elsewhere. So there's still room in portfolios for truly unique US asset, albeit it belongs to a mix of broad regional diversification within the portfolio.
What makes you say then that the easy money has been made in Europe and that it's time to be a lot more selective? What makes you so convinced that we don't have more of this to come? I mean, is it in the hands of Europe or is it in the hands of the White House?
That's exactly the conundrum that we're in, because the European trade, it's a bit of both, right? It's about the push factor away from the US, but also about how much Europe can take matters into their own hands. Then coming back to valuation, we have closed a lot of the valuation gap versus the rest of the world. Europe is still cheap, but that steep discount is no longer there. In terms of the spending that we're talking about, it'll take time for that to come in, so that more into the second bucket of how much can Europe take matters into their own hands. So I think there's still a bit of time to go until we can see true momentum to materialize in Europe when it comes to the fundamental economic picture.
And how are weaker rates in Europe factoring into, or an expectation of cuts in rates in Europe factoring into your thinking then, Anne? Because we have, I was looking at the longer term inflation expectations. I think it's 10-year break-evens in the Eurozone versus the US. And in Europe, we've seen a real retreat in those expectations, and inflation now down below 2%. Yeah. Job done. But over in the United States, that's not the case. How much of that is the rate cut environment helping Europe, do you think?
There is, in our view, there's perhaps a clearer picture, a clearer pathway for rate cuts. So we'll see tomorrow what the ECB delivers. But at the same time, we expect tomorrow 25 basis points cut. But for 2025, we're actually more dovish than the market. We expect 75 basis point cuts versus the market. It's around 50 basis points. Exactly because of that reason, there is more of a disinflationary momentum. But at the same time, that comes with weaker growth. So you have the good news coming from lack of pressure from price levels rising. But at the same time, that comes from more challenges to growth, more risk to growth in Europe. So that rate cut picture, I think, is clearer in Europe versus the US at this point.
Well, yeah, exactly. So you're pricing more cuts than the market, but that's because it's to compensate for the growth hit. Interesting, though, the timeline that you set out. You know, the tariff hit to earnings is kind of long, is into the immediate thing, but then you've got the fiscal boost in the longer term. Just turning back to the trade story, though, you know, you had all this relief from the US-China tariff deal, but the Truth Social posts come thick and fast, and the complaints from both Washington and Beijing about the other side post the Geneva deal. Are investors too quick to price in the optimism before we see some real lasting trade clarity?
On the trade front, on the tariff front, I sense that's a degree of tariff fatigue. At the same time, what we're seeing is markets are reacting less intensely. Every round of tariffs that come around, every round of retaliation that comes around, ever since the pause in the Liberation Day tariffs, I think markets have been reacting less aggressively because we see a bit of a playbook, we see a bit of a Russian function coming out of Trump and the U.S. administration. So there's still nervousness for sure. I think all the investor surveys out there still shows a level of nervousness. At the same time, we see less of a market reaction negatively when it comes to news flow.
So they're fatigued, by the, every little headline, but how much would it change your equity outlook if you had a US-China deal or a US-EU deal?
Look, I think we're not calling for a deal at this point. We think there's still a lot of back and forth to be seen. But at the same time, taking a step back, that policy picture, I think the closer we are to the midterms, the closer we are to re-election, that policy mix and the tones coming out of the White House could sound a little bit more positive. We are seeing a little bit more tax cuts now. We're seeing talks of deregulation. So a lot of the bad news or the less pro-market angle of the administration has been front-loaded so far year to date.
Yes.
But some of the positive sides are coming out as well.
OK, so you think that closeness to the midterms might have an impact on the extent to which the taco trade is in play, or the reaction function of the White House to what we see in markets around trade. What about the closer we get to the midterms, what does that mean for the fiscal outlook in the United States? We've still got the bill, big beautiful bill, trying to make its way through Washington. And are we going to see more market reaction to that, do you think, now than trade headlines?
We definitely have seen more of a focus on the fiscal angle. I think there are periods of time where it seems like the market can only focus its attention on one thing at a time. It's either tariffs or it's the fiscal angle. But I do think the fiscal impetus that the Trump administration is putting out has more impact on the bond market. So the bond market has seen more weakness in the U.S. U.S. Treasuries on the 10-year and 30-year selling off on the back of that fiscal deficit growing. That said, there is a limit at which point where that higher rates in the U.S. can impact the equity market as well, because you have that discount rate factor coming in. But I don't think we're there yet.
Well, yeah, I mean, Musk calling the big, beautiful bill a disgusting pork-filled abomination. And we were talking about the potential impact on the dollar with our previous guest, Jane Foley. Surely that would have an impact through the currency avenue on equities.
We've seen a sell-off in the dollar year to date, quite an aggressive sell-off. That said, periods of dollar weakness can go on for a few years. There are valid structural reasons to be concerned, not least around fiscal deficit, not least around what the U.S. administration is talking about in terms of potential capital controls, etc. But that said, I think a lot still comes down to the outperformance of U.S. assets, the uniqueness of U.S. assets that I just talked about, whether that can continue. And I think as long as there's still room in portfolios for allocation to those U.S. assets that merit an allocation, we've had a period of rebalancing, and we'll see if there's more to go.
OK, thank you very much. Thanks for your perspective. Anne Doe, Portfolio Manager at Julius Baer. Let's have a quick look at the core six then, in Guy's absence. Let's keep track of some of these large heavyweight stocks around Europe. A little bit of a downside move in Nestlé, not much at all. Ferrari as well. But elsewhere, we see some upside coming through. Novo Nordisk is higher. So we'll keep an eye on that. With the addition, I think we just got an Airbus price just flashed up, so that's a bonus. Let's get to Joe Easton, who has some individual stocks on the move for us. Joe.
Well, Airbus investors getting a bit of a bonus as well today. Nice segue there. So Airbus, we're up around 3% on that one today. The Bloomberg Deals team and the transport team writing potentially China going to be buying hundreds of jets from Airbus, potentially even 500 planes, both potentially wide-body and also the shorter-haul jets as well, maybe around 300 in terms of the likely number, but a big boost. Airbus, one of the best performers today, so we're up around 3% on that one this morning. Then a stock going the other way on the same exchanges, Remy Cointreau. got a big unch on the screen, which doesn't do me many favours, but that stock was down around 3 to 4%, so I think it has gone into a trading halt, hence why we've not got a price on that one. But believe me, that stock is down around 3 or 4% at the halt because of the reduced dividend and the guidance withdrawal. Meanwhile, chips doing a bit better. We've got Infineon and ST Micro, both those are actually the best performers in Europe today because the US company onsemi, a big rival in the auto chip space, had a conference yesterday and they were talking about an improvement in the market. That is seen as a direct read-through into both Infineon and ST Micro, according to analysts today. So these stocks, as I say, actually leading the gains on the stock 600 today, given that boost for the sector. Obviously, they have been a bit of an underperforming space over the past couple of years, getting a bit of an uplift today. Then moving over to pharma, a couple in that space. Camurus stock doesn't really come onto the radar too much, but it has got a deal with Eli Lilly. This is on some of their drugs, not quite related to the main obesity sector, but in a similar area in terms of treatment. I think it's related to kind of a diabetes kind of area, and they have got a tie-up gaining around $870 million in that deal. So that stock on our radars this morning. Camurus gaining 28%, so a big move for that one today. And then finally, staying in pharma, Redcare Pharmacy, this one in Germany, one of the worst performers today. It's downgraded at Kepler Cheuvreux. This is all related to a new e-subscription or prescription measure that's coming in Germany, and there's concern around a lack of adoption for this. So it is going to be quite a sweeping change in the German medical market, and uncertainty around that weighing on Redcare today, and one of the worst performers, down 9% on the German market this morning.
All right, Joe Easton from our equities team, we thank you. I just want to clear up the mystery around what happened to Remy just then, because actually it didn't halt trading. It's been flipping between positive and negative. It's back up to by 0.3%. So a bumpy ride for Remy, having withdrawn its outlook.
Yeah, absolutely. Quite volatile. And I suppose going into this, we wondered how much of this would have been priced in by markets. And perhaps that's exactly what markets are wrestling with right now. Duncan Fox over at Bloomberg Intelligence suggesting that the removal of the guidance was entirely in line with what the market had already expected to see here. And so perhaps as that dawns at 13 minutes past 8, that's why you see that volatility coming through in the stock.
Indeed. And Joe had said it's already down 45% this year. So, you know, much of it already baked in there. But coming up on the programme, Bloomberg has learned that China may order hundreds of Airbus aircraft in a high-profile deal that could boost the European firm. We'll bring you more on our scoop next. This is Bloomberg.
Welcome back to the opening trade. 17 minutes into a European session that looks modestly positive. The FTSE 100 now pretty flat, but elsewhere we see some better gains coming through. The Zelter DAX up by 0.6%, for example. In Paris, we're benefiting from some moves higher in Airbus. That stock is up by 2.5% this morning. Bloomberg has learned that China is considering placing an order for hundreds of Airbus aircraft as soon as next month. The deal may align with a visit by the European leaders to Beijing in July. Benedict Cannell is here with the latest on this story. So what do we know about the extent of Chinese appetite for Airbus aircraft then? Good morning, Benny.
Good morning from Berlin. So yeah, there's generally big appetite from China for aircraft, both Boeing and Airbus. But the problem is that right now China is not buying Boeing aircraft because of the political spat that's going on between Washington and Beijing. So Airbus is really the player in town. And what we're hearing, this is according to people that we spoke with, is that there could be a big deal unfolding next week. The way China buys its aircraft is a little different to most other countries where, you know, a single airline will negotiate with a plane maker. China does this centrally. They have sort of a central umbrella organization that then distributes the aircraft among its main airlines. So that's why you sometimes get these huge numbers out of China. So we are hearing somewhere between 250 and maybe even as high as 500 aircraft. Obviously not all in one fell swoop in terms of deliveries. That would unfold over years, but it would be a huge bonus for Airbus. It would really help them cement their market share in China, which is already close to 50%, and it would take them above that. So really an important win for Airbus if it does unfold.
So how does a deal like this reshape the battle between Airbus and Boeing then?
Well, we saw a couple of weeks ago when Donald Trump went to the Middle East that that region bought a lot of Boeing aircraft. And that gives you a sense that aircraft purchases, these large orders, particularly when there's a government involved, tend to turn into a bit of a diplomatic tool. So Trump managed to bring in a big business for Boeing. And now we think that the same might happen when French President Emmanuel Macron and the German Chancellor Friedrich Merz go to Beijing next month. So there's always this sort of political component behind it. Both sides, the Europeans, but also the Americans, trying to strengthen their national champions. And that really is sort of what the duopoly is about. You still have only those two plane makers to choose from. China is trying to build its own aviation industry, its own rival to the 737 Boeing plane and the A320 Airbus. But so far, that remains a local and, at best, regional phenomenon. But it's something that they have to watch, Airbus and Boeing, if they want to maintain a foothold in this crucial market that is China.
And you've nodded to this already, Benny, but there's diplomacy always when it comes to aviation orders. And is this a way for President Xi to send a message to President Trump? President Trump wants a meeting. Xi seeming a little more elusive and not quite so keen to have that phone call. And here we've got a trade deal in the works surrounding European aircraft.
Yes, you're absolutely right, Anna. I mean, that sends a very clear signal that right now China remains open to business, but just not to the US. And we had that the message from Trump this morning saying that Xi remains a very difficult customer to work with. He wants a deal, but he's proving elusive. So, and we also know that China has essentially stopped taking deliveries of Boeing aircraft. So while they have planes on order right now, that entire business for Boeing is on ice. And this is a key market. Yes, there are markets like India. Yes, there is global demand for aircraft. But you can't, if you're Boeing, you can't just sort of ignore the Chinese market. So hopefully over time, they will get back into that market. The question is, will Airbus, by the time that Boeing comes back, will they have strengthened their position to a point where it's going to be very difficult for Boeing to really see eye to eye with their key rival?
Benny, thank you very much. Benedict Camel with the latest on that China, potential for a China order then for Airbus aircraft in the face of troubles at Boeing and trade tensions then, Lizzie, between the United States and China.
Well, speaking of Airbus and those who make military hardware, Bloomberg has learned that UK Prime Minister Keir Starmer is considering a Ministry of Defence request to back NATO's proposed new military spending target of 3.5% of national output by 2032. Now, if this is accepted, it'd be a major test of the UK's already stretched public finances. And digging into this has been our very own Caroline Hepker. She's been looking at the costs of rearming the UK. So, Caroline, it's a really great feature you've got on this today. Can the UK actually commit to more defence spending?
Well, that's the thing. At the moment, we're spending 2.3% of all economic output on military spending. The government has said that it will increase that by 2027 to 2.5%. The 3% goal for the Prime Minister is only an ambition at the moment to reach that by 2034. Now there's this NATO meeting in only a few weeks' time. The pressure is there. We know that the threats have increased, but the issue is whether we are going to be able to pay for that increased spending. So I spent the last month talking to UK defence prime, some of the big contractors in the UK. You know, they are ready, they are poised, but they are effectively paused until they actually get contracts. As part of this sort of deep dive into the defence industry in the UK, Bloomberg Economics also did some analysis about how much it would cost actually to ramp up on spending. If we went to the full 5%, which is an enormous, a colossal target, is what Dan Hansen called it, that would cost £350 billion per year. But as I spoke to a number of former military chiefs, for example, Alan West, who ran the Royal Navy for a long time and then became a minister, you know, he was saying that at the moment the defence cupboard is bare. We have to try to build up after decades of cuts.
OK, and Caroline, as you mentioned, you've been speaking to a number of voices from the industry, including the chairman of Airbus Defence and Space UK. Let's take a listen.
We're well poised to deliver what we're already working on, both on the defence and indeed the commercial side, and we're ready and set to invest more if that's required with future orders or commitments from the UK. This is the year where we and the UK defence industry will hope to see those words turning into action.
So the message there, ready to invest. So what does the business community want to see here?
They want firm commitments. They want contracts. That takes a long time to do. We haven't even gotten into the MOD procurement, so the process of the Ministry of Defence actually procuring weapons, which has been highly criticised, talked about it being bureaucratic. MPs have called the system broken. So the firms that we went to visit, for example, BAE Systems up in the north of England, went to see one of their munitions factories. They are ramping up, but that's in response to past contracts. Now the industry, from top to bottom, including the SMEs that I spoke to, they want firmer commitments from the UK government. So it's basically about whether there's going to be pressure on the Prime Minister to deliver, what welfare cuts, what additional borrowing the government might have to do in order to respond. I was speaking, for example, to Richard Dannett, again, former head of the British Army. He told me only this morning that given the Strategic Defence Review that came out this week and the Prime Minister talking about these big ambitions to rearm, Mark Rutte of NATO is surely going to want to see money committed when actually those ministers meet.
Caroline, thank you very much. Bloomberg's Caroline Hepker with that deep dive, along with the rest of Bloomberg News on the UK defence sector. Let's continue focusing on global geopolitics, shall we, but from a very different angle. Lizzy, we've spent a lot of this morning wondering whether we're going to get any confirmation from the Chinese about whether it is likely that Presidents Xi and Trump will actually speak to each other. Well, some interesting commentary we've just had from the Foreign Ministry in China suggests that maybe some further diplomatic work will be needed behind the scenes to get there, because apparently the Chinese are unhappy by some comments that the Secretary of State Marco Rubio has been making. He praised pro-democracy protesters who 36 years ago, of course, stood up to Beijing in the Tiananmen Square crackdown. And that has not gone down well with China. And as a result, it seems we could be a little further away from that conversation taking place.
Yeah, this just continues Washington's criticism of China's human rights record. But a difficult moment, obviously, for the US-China trade relationship. Yes, we've had the Geneva truce, but it's been eroded day by day by both sides. So really inflammatory comments from Marco Rubio, and the response from China being that this is just wrong. These comments from Marco Rubio, that China is complaining about it, essentially.
Yeah, absolutely. Marco Rubio went so far as to say that the Chinese Communist Party actively tries to censor the facts, but the world will never forget. So clearly that messaging will not land well in China, and as we've seen, there have been some objections to that. So there's the geopolitics. We'll be back in a moment with some of the macro, some of the big names dealing with these macro headwinds.
Yeah, indeed. We've been talking about the push-pull between the US and Europe. It's a theme that Kriti Gupta has been all across at SuperReturn in Berlin. Next, she's going to be speaking to a guest from BC Partners, so do stay with us for that interview out of Berlin. This is Bloomberg. This is the opening trade. We're 30 minutes into today's session, and it's a positive picture for European equities. Half an hour into the open, pretty flat as we look ahead to the Wall Street picture. But let's go from public to private markets now. We can go back to Kriti Gupta, who's at the SuperReturn conference in Berlin. Kriti.
Lizzy, thank you so much. As you said, we are here in Berlin for the SuperReturn conference. My next guest has lots of thoughts on the key themes here, which of course are going to be the kind of longevity of the private markets, where we are in the volatility story, and of course, where that bullishness around Europe takes us. So let me bring him in here now. Nikos Stathopoulos over at BC Partners joining me here today. Thank you so much for your time. Lovely to see you.
Pleasure. Good morning.
Let's start with the volatility here. Just this morning, plenty of tariff headlines crossing the wire. How do you navigate the private markets, a famously illiquid, long-duration asset, when you're dealing with that kind of volatility?
Well, it's true that volatility has continued to be there since the tariffs showed up. I was talking to one of your colleagues a few months ago, and I was hoping that actually this volatility will subside and we will see some normality coming back to the market. It doesn't seem to be the case. That has really impacted private markets because it had meant that deal making has been slow. It has slowed down. It's natural. People are pausing. They're questioning what impact this will have in deals, and it's more natural. I do think that However, that means that people may pivot into industries and investing into industries that have potentially less impact from tariffs, like services. We have been investing in services for a very long time. More than 70% of our portfolio has been in services, has been not impacted by tariffs. So I think you might see some shift in where people will end up investing, at least in the short term, until there's more clarity on tariffs.
Let's take that piece by piece. We'll start with the volatility, then we'll get to the kind of the portfolio construction as well. This was supposed to be the year for capital markets to open up. The IPOs are getting delayed further and further. You talk about deal making hitting a snag, but it's already been hitting a snag. That's been the case for a couple of years now. How much pressure is building up from LPs?
A lot. Liquidity has been probably the biggest issue in the last, I would say, year or two in our industry. And you've heard many times that DPI is the new IRR and how much liquidity is required and distributions back to our investors, which is absolutely the case. So I think that's the biggest issue that we're facing as an industry today. We've been fortunate at BC to return more than 14 billion euros of monetizations the last 18 months, mainly by focusing on the mid-market and high-quality companies. But the reality is our peer group needs to come up with creative solutions on liquidity. Capital markets was one of them, especially for the larger end of companies and of private equity firms. It has not been the case. And frankly, our industry has been hit, and generally the world has been hit from shocks in the last 5 years. If you think about COVID, and then the Ukraine war, and then inflation and interest rates, it had started to recover, and confidence has started to build up until tariffs hit. And therefore, you've seen capital markets effectively being shut at the moment. We were able to IPO a very high-quality business called Springer Nature, actually headquartered here in Berlin in October last year. But it was more the exception than the rule. I think as long as this uncertainty is out there, you will probably see the capital markets not being open, I suspect, until the end of the year, most likely. However, we see a lot of block trades being done, which means, especially in European companies, which means that investors still are keen to invest in European companies in public markets. But I think the actual IPO market feels that it has to be, ideally, a post-summer event.
So what does it do to valuations then? If we're talking about a deal glut, essentially, you're talking about pressure from your LPs, does that demand higher valuations at the end of the day?
Not really. I think valuations have been also hit because the truth is, even though there is supply and demand out there, the cautiousness that we were talking before and the tariff concerns, the growth concerns more importantly, let's not forget, tariffs have impacted inflation, have higher inflation and lower growth, especially in the US, which means that by having lower growth in a company, that means you can price it at a lower multiple.
Yeah.
So valuations will end up being hit ultimately. High quality assets will still get premium valuations, but I do think there's a bifurcation in the market in terms of high quality asset getting the top valuation, and so the medium quality asset where people will be very price sensitive. The IPO markets still remain highly selective, very price sensitive, so I do think it has had an impact on valuations.
Highly volatile, price sensitive, sounds something like Europeans are familiar with this concept. It's also creating this move, of course, when it comes to fund flows from American investors, international investors broadly, into Europe. Talk to us about the bull case there. How much of that is a reaction function to the United States, to kind of this scary aspect of the instability emanating out of Washington, as opposed to a structural change in Europe?
Well, you're talking to somebody who has been investing as a firm. We've been 40 years investors in Europe. So we've been in Europe forever. And we believe in Europe because it has high quality companies and it has a sort of economy which has fundamentals. And therefore, we do think that we can find European or global champions in Europe to invest. There is a bit of a momentum at the moment in Europe, there's no doubt. You probably have heard it from your other guests. I'm sure it's going to be a key theme in this conference this year. And there is a theme in Europe, and rightly so. I mean, as I said, the whole tariff events have impacted mostly, I would say, the growth in the US, and people are seeing Europe as a safe haven at the moment. I do think that Europe, though, has fundamentals, and I don't think it's a short-term exercise that we're facing. I think for some people have noticed potentially Europe more now than they did in the past because US was growing indeed faster. But if you look at the fundamentals, the European economy, Europe and the UK are a $23 trillion economy.
Yeah.
U.S. is around $27 trillion. It's not much smaller than the U.S. So from a size of market, it's similar size. At the same time, it's trading at the same industries at a discount to the U.S. And this is purely because companies who have still similar industry, high quality, global operations, are just happen to be headquartered in Europe. We had identified this many, many years ago, that disconnect between valuations between European and U.S. companies was not really justified. I think people are seeing it now. I think there is a bit of a tailwind that Europe is having at the moment. I hope it's not temporary, because Europe has fundamentally high-quality companies, but it's a complex system to navigate.
Yeah.
And people need to know how to navigate European economies. It's very fragmented, different currencies, different cultures, different tax and regulatory systems. So you need to have people who have local expertise to be able to navigate that system. I think there's a lot of high-quality businesses in Europe that deserve people to notice them and deserve the investment that finally they're seeing now.
I think that opens a nice kind of segue to the financial services point you were making earlier as well. Time and time again, we're talking to these private market players in London and across Europe as well, and even in the States, we're saying you go to defense, you go to AI, you go to infrastructure, the places where the sovereign players are investing the most. You're taking a different approach. Why?
We're taking an approach that ultimately we look at what are fundamentals, characteristics of companies that we as investors and probably our investors are looking for. And if you look at the fundamentals, you need downside protected businesses who have high margins, high cash generation, and the growth momentum. They don't necessarily only need to be in AI. They don't need to be only in tech. These are of course very attractive industries. AI is impacting almost any industry that we look at today. But there are industries out there which are more insulated from tariffs.
Yeah.
Telecoms being one, utilities, services, as I was mentioning before, which fundamentally nothing has really changed in these industries, and they have all these characteristics of companies that we like. So we're taking an approach of investing in fundamentals, not momentum investing, that frankly was the case for some of the tech investments in the last few years, but flying companies from fundamentals.
You make a key point there that financial services are insulated from the traditional hits on things like goods, tariffs, et cetera, and that kind of volatility. Some would argue that that's about to change, and that if you do see some sort of escalation between the United States and the EU specifically, but also in other jurisdictions, services and that services deficit between the US and the EU could be targeted. Is that something that's factoring into your thinking?
We do like services. More than 3/4 of our portfolio is in services.
Is it tariff exposed?
No, these services are not tariff exposed, and that's the beauty of investing in services, or mostly services sectors. They tend to be more local in many cases. They don't have the exposure. You don't produce goods. You don't export goods. You don't rely on other economies necessarily in order to impose certain tariffs. So we have been big fans of the services sector, being healthcare services, being telecom services, being in any other business services a lot, because they're much more insulated. You're much more in control of your own destiny. And we've seen now that this strategy actually is being rewarded, because, again, the external shocks that I was mentioning before are not really impacting that sector.
And it's not under threat from Donald Trump or even regulators here in Europe?
Regulators, depending on the sector, there is always a threat with regulators, and you have to identify against sectors that are not as regulated. So that is not something that people can be insulated from. But I think from tariffs and Donald Trump, I would like to believe that these services sectors are much more insulated, yes.
Well, you'll be our first call if that ever crosses his desk in the Oval Office. Nikos, a pleasure to see you here. Thank you so much for joining me. Anna, that was Nikos Stathopoulos, a partner over at BC Partners, really talking about how you marry the macro with the private markets, especially when it comes to that tariff threat, and certainly in the services sector.
Thanks very much. Kriti Gupta, of course, our opening trade colleague on the ground there in Berlin at SuperReturn. Now, the White House has confirmed President Trump will attend the upcoming NATO summit at The Hague at the end of this month. Trump has said he wants members of the alliance to spend 5% of GDP on the military, in what would amount to a substantial increase from current levels. Joining us now from Berlin, Bloomberg's Oliver Crook on the latest. I believe. Yes, there he is. Take us through the details of this then, Ollie. What is the significance?
Yeah, so listen, Anna, we've been sort of anticipating that Trump would come to this NATO meeting in The Hague, this sort of a really sort of very tense moment here for the NATO alliance, and what feels really like a sort of audition for NATO from the Europeans before Donald Trump, and trying to put forward a number of different initiatives that prove to Donald Trump and the administration that Europe is taking its own defense seriously and stepping up in order to safeguard the continued support of the United States, which, as we know from Donald Trump, is not something that is as guaranteed as many of the Europeans would like to see. And so what we have now been hearing is this number of 5%. It has been swirling around because Trump has talked about it for a long time. But we've heard openly from Mark Rutte, the NATO Secretary General, talking about that 5% figure. We have Friedrich Merz, the Chancellor in Germany, who has all but committed Germany to actually reaching that goal. We've heard about it across the board. And also Marco Rubio, last time he was in Brussels for the defense meeting, he also committed the United States to that 5% goal. So there is a sort of consensus coalescing around that. It is not yet universally adopted. And we should say that that breaks down to about 3.5 percentage points that goes to direct military spending and 1.5 to the sort of infrastructure that supports the military spending. But this all sets up the conversation for 3 weeks from now, for when Donald Trump arrives in The Hague, in those conversations, for, again, what feels more and more like these auditions from the Europeans. And we also have another scoop that came out overnight that another step is going to go forward in that process when we have defense ministers meeting in NATO tomorrow on the European side, saying that they want to quintuple their air defense capabilities over the next couple of years. So you are seeing those incremental steps towards that 5% figure.
Ollie, you mentioned Mark Rutte, a man who knows Dutch politics intimately, and that's the other story that you've been across for us this morning, because, of course, the Dutch government's collapsed after yesterday we reported that the far-right lawmaker Geert Wilders pulled his Freedom Party out of that ruling coalition. So the big question is what happens next for the Dutch government?
Yeah, so now you have the caretaker government. There's going to be another election called. But as you say, Mark Rutte, who I believe had 4 consecutive terms in the Netherlands, he was the longest-serving prime minister over there. He is no stranger to what we've got. And what we have likely in the next election is you likely have, according to the latest polls, Geert Wilders still leading the charge as the biggest party in the Netherlands, though taking away some of the advantage that he had in the election in 2023. But Lizzy and Anna, when we think about sort of dysfunction within politics, you have to look at the Netherlands. The last time they had their election back in 2021, it took almost 300 days to form a government. That government then collapsed on the issue of migration. Another election was held in 2023. That government was formed about 7 months later, and it only held for about 11 months when it has now collapsed again. The difference that there is between now and then is you have all of these major issues that Europe is dealing with, whether it's defense spending, whether it's a trade war with the United States. And what Brussels would like to project is a very strong, stable, pro-European set of governments across Europe. That is not what you've got in the Netherlands. It is not what you got in Poland from a couple of days ago. So in this idea of basically sell America, buy Europe, as we've been hearing from the private equity conference, when you see these levels of political instability, it certainly doesn't help the case ahead of these meetings.
OK, Bloomberg's Oliver Crook, we thank you. And speaking of that Buy Europe story, coming up next on the programme, we're going to be talking about someone who wants to be a winner of this US-China trade war. Will reshoring spark an opportunity for European battery makers? The CEO of Norway-based Morrow joins us next. This is Bloomberg.
Welcome back to the opening trade. Now, Europe's first gigafactory for lithium iron phosphate batteries, LFPs, is gearing up to start commercial deliveries later this year. Morrow Batteries, founded in 2020, is among a handful of remaining European manufacturers seeking to prove that regional producers can carve a niche in the Chinese-dominated market. Joining us now is Morrow's CEO, Lars Christian Bacher. Welcome to the programme. Thanks for joining us. As you're talking to investors and to customers, I wonder how you push back against comparisons with other Scandinavian battery producers that have fallen on hard times. How do you make sure that you don't go the same way as Northvolt and others?
Well, I have 30 years in oil and gas, and when I talk to investors and analysts and companies, the level of competency was extremely high. In this space, it's not at the same maturity level. So there have been different paths into how to do this. When something is very, very complicated, take down complexity. That's something that we have followed. You have to learn to crawl before you can walk, before you can run. So we have taken down the complexity and do this stepwise approach, and are now going to deliver commercial batteries, over the summer. So that's going to be very interesting.
So is your strategy to kind of benefit from the US-China trade war and kind of bet that you need to have a European player in the battery space? Because if that's the way you're going, are you sure that your customers are willing to pay a premium for that?
Well, when we started out, we didn't know about this trade war, and all the tariffs. And in many ways, that geopolitical tension is playing to our strength, our position. And helping us, because more and more people and companies and politicians are talking about friendshoring or onshoring, and that will help. We have always defined Europe as our home market, and but the size of the company and the customers that we are targeting, we are saying that we're not going to compete with Asia, we're going to compete alongside Asia, because there is a space for a company like ours, and yes, customers that we talk to, they are willing to pay more for that diversification.
Okay, and you're serving, it's important perhaps to point out that you are going to be providing batteries for things like trucks, trains, ferries, buses, grid technology, storage, rather than for everyday electric vehicles and passenger cars. Is it different serving that part of the market? Do you need to provide something different?
Well, it would have taken us 4 or 5 years to qualify to become a supplier to an automotive company. We don't have 4 or 5 years, So, and we are not big enough. 3 million batteries a year in production when we produce 24/7. It's not going to make a dent for a company like Volkswagen or Mercedes or whatever. So we have targeted other companies where there is a much higher number of companies and a bigger willingness to kind of pay more, and they can turn around and put that extra cost onto businesses which have a more purchasing power than you and I as an end consumer for an electric vehicle.
If we can switch from demand to supply, you talked about simplifying things, but of course the trade war doesn't simplify things, does it, when it comes to supply chains, and particularly for critical minerals? We've heard the complaints from Washington about that. Where are you sourcing your raw materials from, and how are you preparing for all the volatility?
Well, most of what we source is from Asia. And no wonder that's where the demand for minerals have been. But we also see that there is a growth in number of companies in Europe and North America and elsewhere that want to tap into this market. But I believe that the world will continue to buy batteries from Asia, but they're also going to buy batteries from other places as a sort of de-risking, a dual sourcing strategy, which is typical in all kind of businesses.
Yes, is it really de-risking and dual sourcing though, Lars, if Asian producers and companies in Europe are reliant on materials coming from Asia in the first place?
Well, we have a list of companies that we can buy materials from so that we are independent. We are also developing a totally new chemistry, LNMO, lithium nickel manganese oxide, which has some really strong traits, which are going to be totally independent and cheaper and better than, in many ways, what we have in the market today.
And we've been showing some fabulous pictures of your Gigafactory just during this conversation. I wonder what's the status on production there? Because I think it was meant to start in the second quarter.
Yep. So we are now finalizing the commissioning and in many ways you could say it's a latter stage of the process that we are now focusing on, which is pre-charge and getting kind of the power into the battery and getting the chemistry to work and thereby create a battery. We have very strong yields, meaning numbers in the earlier stages of the production line. So I'm very optimistic with us being able to deliver in not too many months.
So structurally, Lars, you clearly see a need for products such as the one you're making. Yep. In terms of cyclical drivers and the latest news flow, this feels like a pretty uncertain environment. Do you feel comfortable expanding so quickly at a time of great uncertainty?
Well, we are going to do this in a very sort of prudent way. When the market is ready and when the investors are ready, we will grow. But I think it's also a little bit sad that you're able to make it and not capitalize on the opportunity space that is there for an European producer like us. We see stronger, actually, demand from U.S. after the tariff war has sort of started. because then our batteries are cheaper and more relevant, and so there are pluses and minuses in this.
Why not move a factory there then? All right, Lars Christian Bacher, CEO of Morrow Batteries, we thank you for joining us around the table this morning. Now, just as we've been speaking, we've had a breaking news line that the MSCI All Country World Index has risen to top its February record high. So let's bring back Bloomberg's Valerie Teitel for more. What do you make of this, Val?
Hey, the optimism isn't just in U.S. equities. It's across the globe with that stat that we're at all-time highs in the MSCI All World Index. I mean, it goes to show that the rebound in U.S. equities has really driven a rebound globally. I was just checking, how far are we off from all-time highs in the S&P 500? Less than 3% in the S&P 500 off from all-time highs. The NASDAQ less than 3%. Also, the Eurostock 600 around 3% away from all-time highs. So this enthusiasm around this resilient U.S. economy seems to be going global, at least for now. Now, remember, we do have a lot more data to contend with. Yes, it was that strong JOLTS data that led the last jump in U.S. equities. We also have ISM services today. Some speculation that the tariff delay could really support that data set today. ISM services dropping later. We also do get some more hard data on the labor market with jobless claims on Thursday and then the big non-farm payroll print on Friday. So it seems like maybe this equity market exuberance can extend if we continue to get data that bucks the trend of the recent soft survey data.
April seems like such a long time ago, doesn't it, Val? I mean, that's really interesting, though, that the US has played a part in the fact that the MSCI All-Country Index has gone back to these February levels, because it'd be easy to think, well, that we talk a lot about the trade out of the US and into Europe or into rest of world, but actually the performance of the United States, at least in the last month, was pretty strong.
Yeah, maybe that's more evident in FX with the dollar weakening, but yes, it has been a big rebound in U.S. equities, really strong rebound from those lows. Now we're less than 3% away from all-time highs met on February 14th, and I, for one, am bullish at the prospect.
Valerie, thank you very much. Valerie Teitel, with all of the agenda items that you see in front of you there. That she's been through, and where we find ourselves with stocks. And Lizzy, of course, you're off to Frankfurt.
I am going to Heathrow any minute now. My bag is packed.
Excellent.
ECB meeting tomorrow. Looking forward to that cut. That's it for the opening trade. The Pulse is up next. Stay with us. This is Bloomberg.